Hello and welcome again. A few weeks ago I talked about property and whether or not that, in light of all the changes to the tax laws and, stamp duty going up, abandoning reliefs like the wear and tear allowance, and I asked the question whether or not property was still a good investment. Now, the latest one was the possible moves to get rid of the Section 21 notice, which enables landlords to get their properties back without having to find fault, a bit like a no-fault divorce, if you like. So I asked that question, so go back and listen to that episode if you haven't heard it. It's called Is Property Still a Good Investment? And then I've looked at some news in the papers over the weekend, and it seems that a lot of buy-to-let landlords are leaving the market. Now, I think we've known this for a while, and anecdotal evidence suggests that a lot of landlords since 2016, 2017, when these measures were announced to phase out tax relief, that a lot of people started reducing the size of their portfolios and getting out of the market. I did the same thing. Up to that point, I was in the sort of borrow, and the more I borrowed, the more I could buy and the more I could make. But then it did sort of change my mindset a little bit when these measures were announced, because the government clearly are looking to discourage landlords like myself, i.e. the landlord, there's not really the corporate landlord. And in fact, I met a minister at a function who was then the housing minister. He's now a senior minister. I don't want to mention his name, but he's still in the government, senior minister. And I asked him, I said, why are you doing this to your own, voters, really? He's a Conservative housing minister, and I would suggest that a lot of landlords have that Conservative mentality. A lot of people who, a lot of their voters would be the type of people who'd want to save for their retirement through buy-to-let or whatever. And I said, you're really sort of kicking these people in the teeth. And he said, well, we don't want mom and pop landlords and amateur landlords running the private housing sector. We want the corporates. Yes, the corporates. I said, what do you mean the corporates? Where are the corporates? So in other words, he was saying that he was going to reduce or phase out tax relief for the smaller mom and pop landlords, as he called them, because they would have mortgages in their own name, but still allow tax relief on limited companies that, obviously if you have your properties in a limited company, you would tend to be on average a larger landlord, and that's what they've done. Now, obviously some people would have mortgages in limited companies, but they're few and far between, because we're not as available as mortgages to just an individual, and they're still not as available to people who want to put a property inside a limited company. In fact, I was looking at this last year and found that the rates were quite high. They were sort of 3-4% as opposed to sort of 2 and 3%. So the tax relief that you got almost outweighed the additional cost of borrowing, and so it's made it very difficult. And this minister was quite dismissive. I thought he was quite rude, and I had a bit of a go at him. But what can you do? Some of these guys live in a different world, and they've got their fixed ideas, and that's it. I also suggested to him at the time that we should have more interest only mortgages, and for people who just want to borrow money, not have to pay repayments back. And I suggested a lifetime mortgage, particularly for young people trying to get onto the housing ladder, because that would enable them to get into a house cheaply without having to make high repayments that they would on a repayment mortgage, and then stretch it out for 30, 40, 50 years. What's the difference? If it's 10 years, 20, 25 years, the lender has still got that property as security, and they're still getting money for it every month on interest. So why not do that? In Japan, they have lifelong mortgages. In Japan, you can hand the mortgage on to your children. They don't do that here. And he came out with some rubbish about, that would cause negative equity. I mean, I don't know what planet some of these people are born on, actually. But anyway, that was my suggestion. And funny enough, I'll come back to that, because the interest-only mortgages may be making a comeback. There's two companies, Santander and NatWest, that have introduced an interest-only mortgage. And again, now they've been around for buy-to-let mortgages, and I've always done interest only, which means you don't pay back any capital, you just pay interest. But now they were withdrawn after the last financial crash for residential mortgages, and now there's a few coming back in. And I think these are particularly helpful also for older borrowers, perhaps people who want to move on or downsize in their 50s and 60s and can't get a mortgage anymore because they say, well, no, you've got to pay your mortgage off by 65. So you can't underestimate how these mortgage restrictions brought on by the government, then the Bank of England, through the Bank of England, have helped to dampen the market. Because, for instance, the last 3 deals I've tried to go for have all been, if you like, spoiled. I've had to pull out of them because of lending problems. It's a long story. I won't go into everything about it, but the lenders have become more difficult. They're looking at more things. They're restricting buy-to-let. They're restricting people who just want to get on the ladder. And I said to this minister, this is nonsense, because if it costs something like £1,000 to £1,500 a month to rent a property, which if they bought on an interest-only mortgage, they'd probably be paying £500 or £600 a month, maybe even less. Why are you penalising people? Let them have the mortgages. Stop squeezing them and saying, you've got to have this and that. People can't get on the ladder if they can only borrow 3 times income, and the average income is £75,000. How much can a person borrow? The average income is £25,000, and 3 times that is £75,000. Well, that mortgage is not going to get them anywhere, is it? Even if they could borrow 4 times, that's not going to get them anywhere. And this is because they've got to make interest payments and capital repayments. So that was my little rant to the housing minister. Has it changed anything? Not a bit. No, there's still one-way thinking there in that market, and that's the way it's going to stay for the time being anyway. Now, I was talking about buy-to-let landlords, and another government brilliant initiative. They brought in all these restrictions, and surprise, surprise, landlords are pulling out of the market. What will that mean for tenants? It will mean higher rents. So as property prices are falling, Hamptons have reported that rents are still rising. What does that tell you, Mr. Government Minister out there? Come on, let's look at this. Because, we've known this anecdotally, that landlords are pulling out of the market. But now we can see that they are, and their average profit is around £80,000 in 2018. However, this is £4,000 less than their average profit that they were making in 2017. So prices have fallen, obviously, in that time. And it says thousands have been retreating from the market since the 3% stamp duty. Surcharge on rental homes was introduced in April 2016. Then they brought in, as I said, various measures, and they mentioned it, amateur landlords. I find that term that the minister used and the term that the newspapers use, amateur landlords, a bit insulting. Really, it's a bit condescending, because any landlord that pays their taxes, has properties, are trying to do the right thing, is a professional landlord. Okay, they haven't got hundreds of properties, but I think it's a bit condescending to call them an amateur landlord. Okay, if they're an accidental landlord that has just inherited a property and had to rent it out, you could say that they may be an amateur landlord. But even a landlord who's got 2 or 3 properties, they're still a professional landlord. They're not an amateur landlord. And it says here that banks are advancing 4,800 loans a month to landlords, and this probably includes remortgages as well, compared with 16,000 a month in 2017 when buy-to-let was at its peak. And the number of landlords has fallen by 120,000 in 3 years. This is research from the Residential Landlords Association, who found that a quarter of landlords were planning to sell at least one property over the next year. So there you go. I think that it's quite sad that landlords have been kicked in the teeth and are being taxed heavily, and the public perception of landlords is almost up there with politicians, if you like, ironically. But I think most landlords do a good job. They try their best, and it's usually the landlord that ends up with the short end of the stick, that ends up with the raw deal when they get into a dispute with a tenant for sometimes no fault of their own. Landlords who sold in London and the South East were likely to make the most profit, surprise, surprise. However, landlords who sold in the North East, South Tyneside, Sunderland and Darlington and Middlesbrough were more likely to lose money, because I've seen a lot of schemes up there, go and buy these properties for 30, 40, 50,000 and make, rental income, rental yields of, 12, 15%. But, I've always been a bit skeptical about them because some of these places, the prices have not moved very much. And, if you have to get out quickly, sometimes you might not be able to sell those properties very quickly and you could lose. And that's what's happened to some of the landlords here. The areas where landlords are making the most profit were in London, averaging, 1.1 million in Kensington and Chelsea. Well, there's a surprise. Okay, so that's a little bit about what's going on in the property market. I would say that you could look at this two ways. You could say, well, I'm getting out because it's all going south and, it's all doom and gloom. But for those who stay in the market, that there is this little thing that rents are still rising by I think 2% a year. So rents are still going up, and agents tell me there's still a strong demand for rental properties. And in fact, there's still a strong demand for selling properties, for people who want to buy properties. First-time buyer purchases are up, and so it's not all doom and gloom. Just because prices have fallen, it doesn't mean that people are not still moving and buying and selling. And this is a key factor. A lot of agents would tell me, we're selling once the owners have sensibly priced their properties. You know what it's like. An agent comes around and says, well, I can get 500,000 for that, and you think, well, no, I saw one down the road sold for 550 or 600. I want 600, and the agent says, well, fine, we'll put it on for 600. Knowing that you probably can't sell, you won't sell at that rate, and then after a month or so, you go back to them and say, well, let's reduce it. So agents are telling me that things are moving, and solicitors are telling me that things are moving as well. So it's not all doom and gloom. And obviously, for those landlords that stay with it, there will be an increased demand for properties, and rents are going up. So perhaps when others have fled the market, there'll be a better market for those who are left in the buy-to-let market. So you've got to take your choice on that. My advice is to make sure that you are not overstretched with borrowing, because people are now going to be hit in the next year with the loss of tax relief. So where they were getting X amount of net income and paying so much tax, from now on they're going to be paying more tax and finding that their profit and what's left in their pocket is been whittled away by these stealth taxes. So you've got to make sure that you're covered and you're not overstretched, and also that you're not overstretched with borrowing, because in the last financial crisis, lenders went back to people and said, well, your portfolio suggests that you are, your borrowing is up to 75% loan to value, but since prices have fallen, you're now at 90% loan to value. Therefore, we want our money back. And this happened to a lot of landlords here and in America. And a lender, you've got to remember, a lender can call in a loan at any time. Even a mortgage, they've got the right to call that in and say, we want our money back. So, but it's obviously almost impossible for someone to give that money back within a month or 2 months, isn't it? You'd have to sell the property, and during a downturn, what happens? Of course, you can't sell that property, can you? So you've got to be sure that you are able to cover yourself in the event of a downturn. So that's why I sold up a few places and reduced my borrowing and got myself into more cash. And you might want to consider doing the same thing. Other matters that have arisen recently, you may have seen that Metrobank has had problems, and people have, in one branch there was a sort of run on the bank. This means that people all go in and ask for their money back, and ultimately, if everyone goes into the bank and asks for their money back, that bank would go bankrupt because they haven't got that money. That they haven't got all the money that they've taken in on deposits. They've lent that out several times over to borrowers, and they're making money on that. So as always, if everybody goes in and there's what's called a run on the bank, then that bank would fold. So this has not happened entirely to Metrobank, but there was some social media problem the other day, and several customers went in to withdraw the money. But you've got to remember that there is an £85,000 per person compensation scheme for personal customers only on accounts. This doesn't cover business accounts. And in fact, when Metrobank announced an accounting error, I think back in January, business customers went on to withdraw 500 million from deposits since this £900 million accounting error was announced by Metrobank. But if you've got a few thousand in the bank, then I'd say your money is safe. If you don't feel safe, then put it somewhere else. But you are covered by this compensation scheme. That was another thing that came up in the papers over the weekend. And I got a little tip here that was sent in by somebody. I said, if you want to send in tips, then by all means do so. And this is actually from my nephew, Raymond, who sent in a tip. And he says that a few weeks ago I mentioned about switching energy suppliers on one of my earlier podcasts, that it's a good idea to keep an eye on things and switch to a cheaper tariff. But he said that when he switched, he was in credit at the time because he was paying monthly. And if you're paying monthly for your power, your gas and electricity, you're paying a flat rate per month over the whole year. Now, your actual usage will not be the same as what you're paying. So if you're paying £50 a month, in the winter months, your actual usage might run to £70 or £80 a month, but in the summer, it would go down to maybe £25 or £30 a month. I'm just giving average figures here. But over the year, they all average out to what you're paying and what they estimate that you will spend over the year. Now, when he moved suppliers, he was in credit because at certain times of the year, if you've been paying that £50 a month during the summer months, when your usage is low and you switch in, say, September, October, you would be in credit at that time. In the winter, you might be in debit if you look at it the other way around. And he was in credit at that time by a few £100s, and they never gave him the money back. And he had to call them up and ask for this money back. It's incredible. So just watch that. I must say that I would have expected the money to just be refunded. And I have had refunds from power companies, but just look out for that. And in fact, the regulator has brought in a little fine for them. If they don't do that, they can be fined. But just watch out for that. If you do switch any of these providers, watch out that you're not in credit and you are getting your money back. So thanks, Raymond, for that tip. Raymond down in Bromley there. Great tip, and keep them coming in. Raymond's a very sensible guy with his money. He's an accountant by profession, so I'm sure he knows what's coming in and what's going out in his home because he's a very sensible guy. So those are some of the things. Now, if you want one more tip for making money, I've got one here for you, because often we talk about saving money, don't we? We talk about how to save money, etc. And I've got one here where you can actually make money. Now, a lot of people want to invest in the stock market because, other than property, the stock market is probably one of the biggest areas for investment. It's certainly one area that's made the most money for people over the last 50 to 100 years, other than property. But it's a very different animal from property. There are disadvantages and advantages. Buying shares on the stock market means that you're buying shares in a company, and that company value can go up or down, and over each year they should pay you dividends as well, which is your share of the profits from that company. Now, had you invested in a company like Microsoft in the early days, you know 10,000 would probably yield you millions by now. Companies like Google, Amazon have done enormously well, but not all companies do well. So you've got to know what you're doing. Had you invested in, say, Carillion, for instance, you'd have lost all your money because Carillion went bust. And yet, everywhere you looked around London, you could see Carillion signs, and they were building hospitals, and they were on rail projects, and they're a multi-billion-pound company that all went wrong. So you've got to know what you're doing. Now, there's two ways of doing it. You could take a course, couldn't you? You could say, right, I'll take a course. Excuse me a second. Got a little dry throat there. I'll go on a stock market investment course, but not everybody wants to do that, right? Not everyone wants to get into it in that much depth. What I wouldn't suggest is that you just pick a stock and then just place a bet on it like you would on a horse on the Grand National, because that's not the way to invest. So you have got to know what you're doing. Another way, you could hire a stockbroker, and the stockbroker will say, yeah, that's right, I can get you this investment, I can manage your portfolio. But frankly, they're not going to be interested in you unless you've got hundreds of thousands of pounds. Some firms would not be interested in you unless you've got millions, like you're a very wealthy person or a lottery winner or something of that nature. So if people have got a few £1,000s and don't know what to do with it, here is one way you can get into stock market investments without going on a course or without being, a multi-billionaire. And that is, you can start an investment club or join an investment club. Now, an investment club is basically a group of people, a bit like a mastermind really, who get together on a regular basis. It might be once a week, once a month, and they discuss share investments. And you might have, say, 5 or 6 on the radar, and one of you will be tasked to go away and investigate and research that particular share. And, the next meeting you would discuss whether or not to invest in that share. And I think it's an excellent way of getting into it. And you've got the minds of other people, you've got their expertise and their insight. And generally, you would pay a monthly fee into that investment club, and then that money would be invested in the shares. So it's fairly low risk. You'd obviously have agreements and proper terms and conditions and agreements for the investment club. And you can find that from various sort of investment club associations, and you can usually download these things for free. Banks, or some of the banks, will offer an agreement to you. Investment companies will perhaps give you that agreement as well. But there's probably one in your area, so you don't actually need to start your own one. And if they'll have you as a member, I think it's a great way. It's a great way, social way of getting together. Now, some of these clubs have done very well. I was reading about one club that has beaten the market substantially over the last 10 years, and it's also beaten most of these fund managers who have millions and billions of pounds in these funds and charge quite high fees, and yet cannot beat the average market index. When I say the average market index, that means you've got the FT 100 index or the NASDAQ or the Dow Jones. Most fund managers do not beat the average price rise that these indexes go up by. Which is surprising really, because you think that with all their expertise they should be exceeding what the market does on average, right? But there are a number of reasons why they don't. Partly is because some of them are not competent, partly because some of them are just dealing with such huge volumes of funds coming in that these funds have to be invested. So if you want to get into this, go to join an investment club. The other thing you can do is you can put your money into an index tracking fund, which is another way of just saying, well, I'll put it there and forget about it. But don't forget, the market has been rising. So if you look at a graph, it's been rising since the last financial crash, 2008, 2009. So if you'd put your money in an index fund in 2009, you'd have made money, because the market has gradually been going up, apart from a few dips here and there. So everyone is, not everyone is expecting to keep on rising as it has been, and it could well be due for a correction. So just watch that if you're thinking about joining an index fund or putting a lot of cash into an index fund, because index funds follow the index. So if the index has gone down, that your investment value will go down as well. So that's my tip there. Join an investment club, have fun, and hopefully make some money as well. So thanks for listening. This has been Charles Kelly, bringing you money tips to help you save, earn, invest, accumulate, and enjoy more money. So go and enjoy. Thank you.